In this video, we're going to wrap up the unit on financial sector by looking at the money and loanable funds markets. So the first thing it asks is draw the money market, and then it says draw the loanable funds market. And beneath that, it's like money supply and demand shifters and loanable fund supply and demand shifters. So let's go ahead and dive in. First, we're going to draw the money market, and we're going to label quantity of money here and an interest rate up there. And I'm going to draw the loanable funds market next to it so we can see the difference between the two. This one is going to have quantity loanable funds, and this one's going to have a real interest rate. And that's really important, real interest rate, right? That's very, very important for this one. Now, for the money market, you have a fixed supply of money that is determined by the Fed. So that's why we have a vertical line there for the supply of money. But for the loanable funds market, it's an upward supply. And this is people who are lending money. So this is from lenders, or savers is another way to think about it. Okay. So the people providing this one is the Fed, or the central bank, and the one over on the right is people who are lending money and saving money. Now, we have a demand curve for both of them that's downward sloping. Now, the demand for money is made up of all the different people who need money for its different purposes, right? And we talked a little bit about that in class, but I'll look at the shifters here in a second. And then over here, the demand for loanable funds is made up of borrowers. So these are people who actually want to borrow money. It's a subset kind of the whole money market. Now, the money supply and demand shifters, we're going to do supply and we're going to do demand. And I'll make a little T-chart here for you. So the first supply shifter is the Fed. Reserve requirements changes. The second is the Fed, and it's the discount rate. The third is the Fed, and it's open market operations. And so we can shift the curve to the left or to the right. And that's actually to the right and to the left. Anyways, the demand for money can be shifted by anything that really affects people's transaction demand, is typically the example. So we'd say unexpected changes in price levels. So like if things get really, really expensive, then you're going to increase your demand for money. Another one would be national income. And we have a fancy name for that. That would be GDP. GDPR, real GDP, the real amount of output, because if you have more output, then you need more money to go along with it. The third thing that can change money demand is money technology. So mobile payment systems, easy access to your money, those kinds of things, ATMs, that could reduce the demand for money at any given time, because if you know that you can easily get it, then you don't need to carry a whole bunch with you. And then the fourth category is institutions or stability. So as a real example, right, bring it home here for a second. Right before all this coronavirus pandemic happened, I went out and withdrew a great deal of cash because I was a little concerned about what the future held, right? And I knew that a whole bunch of other people did the same. In fact, in Russia, they had to limit the amount that people could withdraw from banks because people were so untrusting of the banks there. Now let's look at the loanable funds supply and demand. So this one is going to be a little different because we're talking about different actors, right? In this case, now we're talking lenders, savers, and borrowers. So the supply of loanable funds can be affected by the central bank actions, so the Fed, and that would be if the Fed increases or decreases the supply of reserves for banks, we could say that that could influence the bank's lending. So anything that maybe increases the supply of money can change the supply of loanable funds. Okay? The other direction doesn't necessarily work that way, but just to think about it that way. The next would be savings rates. And what we observe is that people save a certain percentage of their income. And if that changes, that can increase or decrease the amount of money available to loan out to people. A third would be price levels. And so in this case, we're saying if unexpected inflation happens, then lenders are going to be less likely to loan out money because they don't want to be stuck without the money when they need it. So high inflation rates can actually decrease the amount of lending activity. because those savers want to keep the money for themselves. And then the last one is international capital flows, which is a fancy way of saying that sometimes people from other countries want to put their money into your country, and that depends on the different real interest rates. Now, the demand for loanable funds is affected by three things. It would be private borrowing, and so obviously if people want to borrow more, that increases the demand. Government borrowing is another one. So if governments borrow a lot, like in the last 3 months, the government, the second quarter of 2020, the government has borrowed $3 trillion. That's with a T. A lot of money. And price levels. And this one is it's a double shifter, right? Because if there's really high price levels, then that can increase the demand for loanable funds because people need to borrow more in order to finance their transactions. Okay, so now we're going to switch back to the typing here a little bit. And the last little bit here of these questions. All else being equal, if the government increases spending and cuts taxes, how does it affect the loanable funds market? Well, that would increase government borrowing, which increases demand for loanable funds. Well, now in class we said or decreases the supply of loanable funds, so you could say that too. And that increases the real interest rate. Okay. Now, the last question on here, if the real interest rate blank, well, why don't we just use the one that's up here in number 5. If the real interest rate increases, then investment spending is going to decrease. And that actually can affect productive capacity. In the long run, it decreases it because there's less spending on machines and new construction. And that slows down or decreases economic growth rates. So this is a really important chain that you may see questions about on the AP Macro. Hopefully you were able to analyze all of this and do okay. I'll see you next time.